Many people have ignored the warnings that they should have heeded from the collapse of Silicon Valley Bank, Signature Bank, and First Republic Bank. Today, I would like to revisit these concerns. Not a single bank regulator, politician, or bank CEO has addressed the billions of dollars in unrealized losses that are still sitting on the books of many banks. This problem was not limited to those 3 banks that made headlines. An unrealized loss, as the name suggests, is a loss in value on an asset that has not been sold or disposed of. In practical terms, an unrealized loss can be thought of as a paper loss. It is real because the value of the asset has declined. However, the bank is not required to recognize or report the loss until the asset is actually sold. Once the asset is sold, the loss becomes realized and hits the income statement. When securities are purchased by banks, they're not required to be marked to market. This is an accounting term that means that the banks continue to carry the securities on their books with a value equal to their purchase price. The banks are not required to adjust the value of the securities on their books to accurately reflect their current market value. The banks are not required to mark-to-market the value of the securities from time to time, or revise the value of the securities on their books at the current market value. In accounting terms, an unrealized loss is the difference between what the market is willing to pay now for your asset versus what you paid when you bought it. U.S. banks are currently sitting on billions of dollars of unrealized losses. Let's review how this works in practice. Suppose a bank or any other investor purchases a treasury bond when market interest rates for treasury bonds are at 2%. Then, suppose the Federal Reserve raises interest rates and the prevailing market interest rate for treasury bonds rises to 5%. Obviously, the value of the bond purchased at 2% is worth less than when it was purchased because investors can now buy a bond that pays 5%. In fact, this is what has happened. Silicon Valley Bank, Signature Bank, and First Republic Bank and many other banks purchased treasury bonds when interest rates were very low. Now the value of those bonds has greatly declined in value. If the true value of all of those securities were to become realized all at once, our banking system would collapse. There's no doubt about that. According to the Federal Deposit Insurance Corporation (FDIC) quarter report, unrealized losses on U.S. Treasuries and mortgage-backed securities held by U.S. banks increased by 22%, or $126 billion, as of the end of the third quarter, as of September the 30th. This is the latest data available. Because the FDIC publishes this report typically 50 to 60 days after the quarter ends, the total amount of unrealized losses as of September the 30th is reported to be $684 billion. This number obviously would have been far greater if the FDIC had not taken over those banks when they did. Furthermore, those banks were by no means the only banks affected by this problem. Many banks invested in bonds when rates were low. Then the Fed hiked interest rates. This resulted in declines in both types of securities, those to be held to maturity as well as those available for sales. The securities declined in value. A total balance of $684 billion is technically unrealized. Banks may decide to keep them on their books until the securities fully mature, in which case the unrealized loss would completely disappear. However, that it is an unlikely scenario. The reason is that many banks cannot afford to hold on to these securities, especially if there is a significant credit event or some type of a downturn. In such an event, they need to access additional funding. They need the money now. Banks have to be liquid to operate, so to gain that liquidity, a bank would be forced to sell devalued securities at a loss. At this point, millions or even billions of dollars of realized losses would hit their bottom line. So far, banks have managed to deal with unrealized loss, thanks to being able to borrow from the Fed's program called Bank Term Funding Program. Effectively, this is a short-term bailout program that the Fed provides. If banks are required to borrow money using their securities that had lost value, this would cause substantial losses when sold. This program is kind of like a band-aid. It doesn't really solve any issues. It doesn't solve any problems, but it does allow several options. It buys time and it postpones the time when the problem must be faced. Besides, surging unrealized losses that are reflected in the latest FDIC data shows important key facts about the state of the U.S. banking system. First, the FDIC is telling us that net income for the banks has decreased from the prior quarter. This was driven by lower non-interest income and higher realized losses on securities. When the third quarter ended, mainstream media was trying to hype up the bank's performance by saying that their earnings increased as the result of higher interest rates. The media did not actually take time to either understand or explain what is happening. In reality, community banks reported lower net income from the prior quarter. There is quite a bit of concern relating to the smaller banks. There is concern about small to mid-sized banks and their ability to manage what's going on with interest rates, what's going on with their real estate portfolios, and the economy in general. So I'm sure that we will hear a lot more about community banks not being able to manage. Also, total deposits declined for 6 consecutive quarters. According to the FDIC, net income decreased from the prior quarter driven by lower non-interest income and higher realized losses on securities. Third quarter net income for the 4/6/14 FDIC insured commercial banks and savings institutions declined by $2.4 billion from the prior quarter to $68.4 billion. Lower non-interest income and higher realized losses on securities drove the decline in net income from the previous quarter. The FDIC just mentioned in passing that higher realized losses on securities caused a drop in net income. We will likely see this more frequently when small to mid-sized banks need to access additional liquidity and are forced to sell their undervalued securities at a loss. Needless to say, if the Federal Reserve continues with its high interest rate policy, we will see many more stories like this. And the longer the Fed keeps rates high, the longer the banks will have to use FDIC's bailout program by borrowing against their devalued assets. Thank you for watching. Remember, always do your research and consult with financial professionals before making investment decisions. The information provided in this video should not be construed or relied on as accounting or legal advice for any specific fact or circumstance. If you found this video helpful, give it a thumbs up, and don't forget to subscribe. If you leave a message below, I will respond. You also might like to check out my pages on Facebook and Rumble, the Global Macro Digester, and see my books that are featured there.